They say success is the best revenge. Heard they were sleeping again, say no more.
Welcome back to the channel, everybody. It's great to see you all again. Today we're diving deep into a topic that's crucial for any trader, whether you're just starting out or you've been in the game for a while. This is something that can make or break your trading career. We're talking about stop losses, but not just the technical how-tos. We're going to explore the deeper layers of this concept. We're going beyond the charts and into the psychology of why mastering stop losses is so important. It's not just about numbers, it's about understanding your own mind. Trading, my friends, is often seen as this exciting, fast-paced world where fortunes are made and lost overnight. The thrill of the market can be intoxicating. And while that can be true, the reality is that successful trading is more about discipline, strategy, and yes, psychology, than it is about chasing quick wins. It's about playing the long game. Think of it like this. Trading is like alchemy, trying to turn lead into gold. The alchemists of old were searching for a way to transform base metals into something precious. But unlike the mythical alchemists, we have very real tools and techniques at our disposal. We have technology, data, and strategies that can help us achieve our goals. One of the most powerful tools in a trader's arsenal is the stop loss. It's a safeguard, a way to protect your investments. It's a simple concept, really. You set a predetermined price at which you'll automatically exit a trade if it goes against you. Sounds straightforward, right? You set a predetermined price at which you'll automatically exit a trade if it goes against you. Sounds straightforward, right? But there's more to it than meets the eye. Well, here's the catch. Even though it's a simple concept, implementing it effectively and consistently is where many traders stumble. Why? Because there's a whole psychological game at play that often prevents us from setting stop losses or sticking to them when emotions run high. Because there's a whole psychological game at play that often prevents us from setting stop losses or sticking to them when emotions run high. Fear and greed can cloud our judgment, leading us to make irrational decisions. To master the art of stop losses, you need to master your emotions. This means developing a mindset that can withstand the ups and downs of the market. It's about staying calm and composed, even when things get tough. One way to do this is by educating yourself about trading psychology. There are countless resources available, from books to seminars, that can help you understand the mental aspects of trading. Another effective strategy is practicing mindfulness. By being present in the moment and aware of your thoughts and feelings, you can better manage your emotions and make more rational decisions. Setting realistic goals is also crucial. Instead of aiming for unrealistic profits, focus on consistent, steady growth. This will help you stay disciplined and avoid making impulsive decisions. Having a mentor or a trading buddy can also be incredibly beneficial. They can provide you with valuable feedback and help you stay accountable to your trading plan. Regularly reviewing your performance is another key aspect of mastering stop losses. By analyzing your trades and identifying patterns, you can learn from your mistakes and improve your strategy. Remember, trading is a journey, not a destination. Celebrate your successes, no matter how small, and use them as motivation to keep going. With the right mindset, discipline, and strategies, you can master the art of stop losses and become a successful trader. So, keep learning, stay focused, and never give up. I hope you find this deep dive into the psychology of stop losses helpful. If you did, don't forget to like, comment, and subscribe. This brings us to what I call the stop loss paradox. It's a concept that many traders, both novice and experienced, grapple with on a daily basis. The paradox lies in the fact that while we intellectually understand the importance of stop losses, emotionally, we often find it challenging to implement them consistently. We know logically that stop losses are essential for managing risk and protecting our capital. They act as a safeguard, a predetermined point at which we exit a trade to prevent further losses. This is crucial because the market can be unpredictable, and without a stop loss, a bad trade can quickly spiral out of control. They're like the safety net that prevents us from falling into the abyss of massive losses. Imagine a tightrope walker performing high above the ground. The safety net below provides a sense of security, allowing the performer to focus on their act without the paralyzing fear of falling. Similarly, stop losses provide traders with the confidence to make informed decisions without the constant dread of catastrophic losses. Yet, there's this internal resistance, this invisible force that holds us back from using them effectively. This resistance often stems from a fear of being wrong or the discomfort of admitting a mistake. It's a psychological battle where our emotions clash with our rational mind. It's like knowing you should eat your veggies, but reaching for that extra slice of pizza instead. We understand the benefits of healthy eating, yet the allure of immediate gratification often wins. In trading, this translates to holding on to losing positions in the hope that they will turn around, rather than cutting our losses and moving on. We often prioritize immediate gratification over long-term benefits, and in trading, this can be a recipe for disaster. The desire to avoid short-term pain can lead to long-term suffering. So what's the solution? How do we overcome this paradox and make stop losses an integral part of our trading strategy? The first step is to acknowledge that these psychological barriers exist. By recognizing that our reluctance to use stop losses is rooted in our emotions, we can begin to address the issue more effectively. We can't conquer what we don't acknowledge. Self-awareness is the foundation of change. By understanding our own psychological tendencies, we can develop strategies to counteract them. We need to understand the root causes of our reluctance to embrace stop losses. This might involve examining past experiences, identifying patterns in our trading behavior, and seeking insights from psychological research. It's about digging deep to uncover the fears and biases that influence our decisions. And that's exactly what we're going to do today. We'll explore the common psychological pitfalls that traders face and provide practical strategies to overcome them. This isn't just about theory, it's about actionable steps that you can implement in your trading routine. We'll break down these psychological barriers, expose the common pitfalls, and give you practical strategies to overcome them. For instance, setting predefined rules for stop losses can help remove the emotional element from the decision-making process. By automating this aspect of trading, we can ensure that our rational mind prevails over our emotional impulses. By the end of this video, you'll not only understand the why behind stop losses, but also the how to implement them effectively, allowing you to trade with more confidence and control. You'll learn techniques to manage your emotions, develop a disciplined approach to trading, and ultimately protect your capital while maximizing your potential for success. So, let's dive in and unravel the stop-loss paradox together. Let's talk about this invisible handbrake that seems to be pulling us back. It's a force that many traders feel but can't quite put their finger on. It's that nagging hesitation, that moment of doubt, that keeps us from making the decisions we know we should. Every time we think about setting stop losses, this invisible handbrake kicks in. It's like a mental block that prevents us from taking the necessary steps to protect our investments. We know the importance of stop losses, yet we hesitate. One of the primary culprits is the fear of loss. This fear is deeply ingrained in our psyche. It's not just about losing money, it's about the emotional pain that comes with it. The anxiety, the stress, the feeling of failure. All these emotions can be overwhelming. It's human nature to avoid pain, and in the trading world, losses represent that pain. We are wired to seek pleasure and avoid discomfort. This is why the thought of setting a stop loss, which acknowledges the possibility of a loss, can be so daunting. When we set a stop loss, we're essentially accepting the possibility of a loss up front. It's like admitting defeat before the battle has even begun. This can be a tough pill to swallow, especially for those who are new to trading. For novice traders, the concept of a stop loss can be particularly challenging. They haven't yet experienced the sting of a significant loss, so the idea of preemptively setting a limit on their potential losses can seem counterintuitive. They might think, why should I plan for failure? Another major psychological barrier is overconfidence. This is the belief that we are better than the average trader, that we have a unique insight or edge that others don't. This overconfidence can be a double-edged sword. We all like to believe we're smarter than the average trader, that we have a special knack for reading the markets. This belief can give us the confidence to make bold moves, but it can also blind us to the risks. We might think that we can time the market perfectly, that our analysis is always on point. This can lead us to take unnecessary risks, believing that we can outsmart the market. But the reality is that no one can predict the market with absolute certainty. Even the most thorough analysis can be wrong. The market is influenced by countless factors, many of which are beyond our control. This overconfidence can lead us to believe that we don't need stop losses, that we can get out of a trade before it turns against us. We might think that we can always react in time to avoid significant losses, but the market can be unpredictable and volatile. News events, economic data, and other factors can cause sudden and unexpected movements. By the time we realize what's happening, it might be too late to act. The market has a funny way of humbling even the most seasoned traders. No matter how experienced or knowledgeable we are, there will always be times when the market moves against us in ways we didn't anticipate. And when that happens, the lack of a stop loss can magnify losses exponentially. What might have been a manageable loss can quickly spiral out of control, leading to significant financial damage. It's important to reflect on our past trades and learn from our mistakes. By understanding the psychological barriers that hold us back, we can take steps to overcome them. Setting stop losses is a crucial part of risk management, and it's something that every trader should take seriously. So, the next time you feel that invisible handbrake, remember that it's just a mental barrier. Acknowledge it, but don't let it control your actions. Take control of your trading strategy, set those stop losses, and protect your investments. In the long run, you'll be glad you did. Here's the thing about trading psychology. It's not just about the fear of loss or overconfidence. It's also about the emotional attachment we develop to our trades. We put in the time and effort to research, analyze, and execute our trades, and it's easy to become emotionally invested in them. We start rooting for our trades to work out, even when the market tells us otherwise. This emotional attachment can cloud our judgment and make it incredibly difficult to stick to our stop losses. We might convince ourselves that the market will turn around, that our analysis is still valid, even as losses start piling up. This is where discipline comes into play, and it's a muscle that needs to be trained just like any other. Mastering the mindset. Mastering the psychology of stop losses is about shifting our mindset. It's about accepting that losses are a part of the game, that no one wins every trade. It's about detaching ourselves emotionally from our trades and treating them as business decisions. It's about understanding that a stop loss is not a failure. It's a strategic tool that helps us manage risk and protect our capital. In the upcoming sections, we'll delve deeper into the practical strategies you can implement to overcome these psychological barriers and develop the discipline to stick to your stop loss orders. We'll explore techniques to help you define your risk tolerance, set realistic stop loss levels, and avoid common pitfalls that can sabotage your trading success. Remember, mastering the psychology of stop losses is an ongoing journey, not a destination. The ego trap. Let's face it. Trading can be an ego-driven endeavor. We see those stories of traders making millions, and we want a piece of that action. We start to identify ourselves as traders, and with that identity comes a certain image we want to project. Admitting we need stop losses can feel like admitting defeat, like we're not as skilled or as knowledgeable as we think we are. We tell ourselves, I'm a good trader, I'll know when to get out. But the market doesn't care about our ego or our self-perception. It operates based on supply and demand, on algorithms and news events, on factors far beyond our control. The sooner we can detach our ego from our trading decisions, the sooner we can approach stop losses with the objectivity they deserve. The sunk cost. Fallacy. Another psychological trap that keeps us from using stop losses effectively is the sunk cost fallacy. This is the tendency to stick with something, a trade in this case, simply because we've already invested time, money, or emotional energy into it. We rationalize holding onto a losing trade by saying things like, I've already lost this much. I might as well see if it turns around. But this is dangerous thinking. In trading, past losses are irrelevant. What matters is the current price action and the potential for future profits or losses. Holding on to a losing trade in the hope that it will recover is like throwing good money after bad. The just one more trade syndrome. This one is particularly prevalent in day trading and short-term trading. We have a winning trade, we're feeling good, and we want to keep that momentum going. So we jump into another trade, often without the same level of analysis or consideration. We tell ourselves, just one more trade, I'm on a roll. But this is where discipline goes out the window. Each trade should be approached with the same level of objectivity and risk management, regardless of whether the previous trade was a winner or a loser. The just one more trade mentality can quickly erode your profits and lead to impulsive decisions driven by greed rather than strategy. The fear of missing out, or FOMO. FOMO, the bane of modern existence, and trading is certainly not immune. We see a coin pumping, a stock soaring, and we don't want to be left behind. We feel this urge to get in on the action, even if we haven't done our due diligence, or if the trade doesn't align with our overall strategy. This fear of missing out can lead us to make hasty decisions, entering trades without setting appropriate stop losses because, hey, this one's a sure thing, right? Wrong. FOMO often leads to chasing pumps, buying at the top, and then riding the price down as reality sets in. The illusion of control. Trading can give us a false sense of control. We have charts, indicators, news feeds, and we feel like we have a handle on what's going on. But the truth is, the market is a complex, unpredictable beast. We can't control its every move, no matter how sophisticated our analysis might be. This illusion of control can lead us to believe that we don't need stop losses because we can anticipate and react to every market movement. But the reality is, unexpected events happen, news can break. Algorithms can go haywire, and the market can move against us faster than we can react. We all have biases, and in trading, confirmation bias can be particularly dangerous. This is our tendency to seek out information that confirms our existing beliefs and ignore information that contradicts them. We might have a bullish outlook on a particular asset and will selectively focus on news articles, analyst opinions, or social media posts that support that view while downplaying or dismissing any negative information. This confirmation bias can lead us to hold on to losing trades longer than we should because we're so convinced we're right, even when the market is telling us otherwise. So, we've covered a lot of ground here, exploring the psychological barriers that can prevent us from using stop losses effectively. The ego trap, the sunk cost fallacy, the just one more trade syndrome, FOMO, the illusion of control, and confirmation bias. These are all powerful forces that can sabotage our trading success. But here's the good news. By recognizing these patterns, by becoming aware of these psychological pitfalls, we can start to break free from their grip. Awareness is the first step towards change. In the next part of video, we're going to shift gears and talk about the practical strategies you can implement to overcome these barriers and develop the discipline to stick to your stop loss orders, come rain or shine, profit or loss. All right, so we've talked about the psychological barriers to setting stop losses. Now let's get real about the consequences of not using them. One of the most significant dangers is what I call the domino effect. You see, when you don't have a stop loss in place and a trade goes against you, it's easy to fall into the trap of hoping it will turn around. You tell yourself, it's just a temporary dip, or the market will bounce back any minute now. But hope is not a trading strategy. As the losses mount, you might hesitate to exit the trade, clinging to the belief that you can still salvage something. This hesitation can lead to even more significant losses, creating a domino effect that can wipe out a substantial portion of your trading capital. The impact of not using stop losses isn't always a sudden, dramatic crash. It can be a slow and silent erosion of your capital, like water dripping on a stone, gradually wearing it down over time. Every time you hold on to a losing trade longer than you should, you're chipping away at your account balance. These small losses might seem insignificant at first, but they add up over time, eating into your profits and making it harder to recover. It's like having a leak in your boat. You might not notice it at first, but eventually, that slow and steady drip will sink your ship. Trading is inherently stressful, even for the most experienced professionals, but not using stop losses amplifies that stress to unhealthy levels. When you don't have a predetermined exit point for your trades, you're constantly on edge, watching the charts like a hawk, worried about every tick up or down. This constant anxiety can take a toll on your mental and physical health. It can lead to sleepless nights, poor decision-making, and even health problems down the line. Remember, trading should be challenging, but it shouldn't feel like you're constantly on the verge of a breakdown. Here's a dangerous path that many traders fall into: the revenge trading spiral. You experience a significant loss, likely because you didn't use a stop loss, and you're feeling angry, frustrated, maybe even a little bit humiliated. You want to win back your money, so you jump back into the market, often with even riskier trades driven by emotion rather than logic. This revenge trading mentality is a recipe for disaster. It clouds your judgment, leads to impulsive decisions, and often results in even more significant losses. The cycle of overtrading, chasing losses. Revenge trading often goes hand in hand with overtrading. You're trying to make up for your losses, so you start taking more trades, often without proper analysis or risk management. You're chasing losses, hoping that the next trade will be the one that brings you back to even. This cycle of overtrading can be incredibly destructive, both financially and emotionally. It's like digging yourself into a hole. The deeper you dig, the harder it is to climb out. The missed opportunities. Paralysis by analysis. Now, you might be thinking, okay, I get it. Not using stop losses is risky. But what about being too cautious? What about missing out on potential profits because my stop loss was too tight? This is a valid concern, but it brings us back to the importance of finding the right balance. A well-placed stop loss shouldn't be so tight that it gets triggered by normal market fluctuations. It's about defining your risk tolerance, understanding the volatility of the asset you're trading, and setting a stop loss level that allows for some breathing room while still protecting your capital. Damage beyond the dollars. The consequences of not using stop losses extend far beyond the immediate financial losses. Repeated losses due to poor risk management can erode your confidence, leading to self-doubt and a fear of trading altogether. It can damage your reputation, especially if you're managing other people's money. And perhaps most importantly, it can take a toll on your passion for trading, turning what was once an exciting endeavor into a source of stress and anxiety. Remember, trading is a marathon, not a sprint. Alright, let's shift gears now and talk about practical strategies for setting and sticking to stop losses like a pro. The foundation of any successful trading strategy is a well-defined trading plan. Think of it as your trading blueprint, your roadmap to navigating the markets. It outlines your trading goals, your risk tolerance, your preferred trading style, and most importantly, your risk management strategy, which includes your approach to stop losses. Without a plan, you're just shooting in the dark, hoping for the best. A trading plan brings structure and discipline to your trading, helping you make rational decisions even when emotions run high. Before you even think about setting stop losses, you need to define your risk tolerance. This means understanding how much money you're comfortable risking on a single trade and how much drawdown you can handle in your overall portfolio. Your risk tolerance will depend on several factors, including your financial situation, your investment goals, your time horizon, and your emotional makeup. There's no right or wrong answer here. It's about finding what works best for you. Remember, trading is about managing risk, not avoiding it altogether. Now, let's talk about the sweet spot of stop-loss placement. The key here is to find a balance between protecting your capital and giving your trade enough room to breathe. A stop-loss that's too tight will likely get triggered by normal market fluctuations, taking you out of potentially profitable trades prematurely. On the other hand, a stop-loss that's too loose won't provide adequate protection if the market moves sharply against you. So how do you find that sweet spot? It involves considering the volatility of the asset you're trading, identifying key support and resistance levels, and factoring in your own risk tolerance. The art of entry. Timing is everything. The timing of your trade entry can significantly impact the effectiveness of your stop loss. Entering a trade at a point of high volatility or uncertainty increases the likelihood of your stop loss being triggered, even if the trade ultimately goes in your favor. Ideally, you want to enter trades when volatility is relatively low and there's a clear trend in place, giving your trade a better chance of moving in your intended direction. Remember, patience is a virtue in trading. Waiting for the right setup can make all the difference. Stop-loss placement strategies. Technical versus discretionary. There are two main approaches to stop-loss placement, technical and discretionary. Technical stop-losses are based on chart patterns, indicators, or specific price levels, such as previous swing highs or lows. Discretionary stop-losses, on the other hand, are based on the trader's judgment and intuition, taking into account factors such as news events, market sentiment, or their own assessment of the trade's risk-reward ratio. The best approach often involves a combination of both technical and discretionary methods, using your knowledge and experience to fine-tune your stop-loss placement. Automating your defense. In today's digital age, we have access to incredible trading tools and platforms that can automate many aspects of our trading, including stop-loss orders. Most trading platforms allow you to set stop-loss orders directly within the platform, automatically exiting your trade when the price hits your predetermined level. This automation takes the emotion out of the equation, ensuring that your stop-losses are executed precisely as intended, even if you're not physically at your computer. Take advantage of these technological advancements to enhance your risk management strategy. Don't sabotage your success. Now, even with the best laid plans and the most sophisticated tools, traders can still fall prey to common pitfalls that sabotage their stop-loss discipline. One common mistake is moving your stop-loss further away from your entry point as the trade moves against you. This might seem like you're giving the trade more room to breathe, but it's actually increasing your risk exposure and violating the fundamental principle of cutting your losses short. Remember, your stop loss should be based on your predetermined risk tolerance and your analysis of the trade, not on your emotional attachment to the position. Sticking to your guns. Perhaps the most challenging aspect of using stop losses effectively is maintaining discipline. It's easy to set a stop-loss order when you're calm and collected, but it's a whole different ballgame when the market is moving against you and your emotions are running high. This is where discipline comes into play. Discipline is the ability to stick to your trading plan, to execute your stop-losses as intended, even when it's the last thing you want to do. It's about trusting your strategy, managing your emotions, and making rational decisions even under pressure. Embracing losses. The necessary evil. Here's a hard truth about trading. Losses are inevitable. No one wins every trade, and if you're not prepared to accept losses, you're not going to last long in this game. The key is to embrace losses as a necessary part of the process, as learning experiences that can help you improve your trading strategy. Don't let losses define you as a trader. Instead, view them as opportunities for growth and development. Building confidence through consistency. Mastering the psychology of stop losses is an ongoing journey, not a destination. It takes time, practice, and the willingness to learn from your mistakes. But as you develop your trading plan, refine your stop loss strategies, and build your discipline, You'll start to see the positive impact on your trading performance. You'll experience fewer emotional highs and lows. You'll protect your capital more effectively, and you'll be able to approach trading with a greater sense of confidence and control. Remember, trading is a marathon, not a sprint. And by mastering the psychology of stop losses, you're setting yourself up for success in the long run. The stop loss mindset shift from fear to freedom. We've covered a lot of ground in this deep dive into the psychology of stop losses, and if there's one key takeaway I want you to walk away with, it's this. Mastering stop losses is about shifting your mindset from fear to freedom. For many traders, the thought of setting a stop loss is paralyzing. It represents the possibility of loss, of admitting defeat, of acknowledging that they might be wrong. But here's the paradox. By embracing stop losses, by accepting the possibility of small, controlled losses, you actually liberate yourself from the fear that holds so many traders back. You're no longer trading from a place of fear, hoping and praying that the market will move in your favor. Instead, you're trading with a clear head, a defined strategy, and a safety net in place. Trading with a clear head. Think about it. When you know you have a stop loss in place, you can approach your trades with a greater sense of confidence and clarity. You're not constantly second-guessing yourself, wondering if you should have exited the trade sooner. You're not letting your emotions dictate your decisions. Instead, you're trusting your strategy, you're trusting your analysis, and you're letting your stop loss do its job, which is to protect your capital from catastrophic losses. This newfound confidence can translate into better decision-making, more disciplined trading, and ultimately, more consistent profits. Protecting your gains. One of the most overlooked benefits of using stop losses is the power of compounding. You see, when you're able to protect your capital from significant losses, you're giving your profits a chance to compound over time. Compounding is like a snowball effect. As your profits grow, they generate even more profits, creating a virtuous cycle of growth. But even small losses can significantly impact your compounding potential. By consistently using stop losses, you're ensuring that your trading capital remains intact, allowing you to capitalize on future opportunities and maximize your long-term returns. The journey to mastery. Continuous improvement. Remember, mastering the psychology of stop losses is not a one-time event. It's an ongoing journey of self-discovery, discipline, and continuous improvement. There will be times when you're tempted to move your stop loss, when you'll feel the urge to chase losses, when your emotions will cloud your judgment. But the more you trade, the more you practice discipline, the better you'll become at managing your emotions and sticking to your trading plan. Embrace the learning process, analyze your trades, identify areas for improvement, and never stop refining your approach to risk management. The journey itself is where the real growth happens. Beyond the charts, a holistic approach to trading. The psychology of stop losses is just one piece of the trading puzzle. To truly succeed in the markets, you need to adopt a holistic approach that encompasses not only technical analysis and risk management, but also mindset, discipline, and emotional intelligence. Take care of your physical and mental health, manage stress effectively, cultivate patience and resilience, and never underestimate the importance of a positive mindset. Remember, trading is a marathon, not a sprint, and your overall well-being is just as important as your trading account balance. Final thoughts. Embrace the stop loss, embrace success. So, there you have it, folks. The psychology of stop losses is a complex and often overlooked aspect of trading, but it's an essential skill that can make or break your success in the markets. By understanding the psychological barriers that prevent us from using stop losses effectively, by developing the discipline to stick to our trading plans, and by embracing losses as part of the learning process, we can transform our trading from a fear-driven endeavor into a confident and profitable pursuit. Embrace the stop loss, my friends, and embrace the limitless potential that comes with mastering your trading psychology.